view is that we will continue to see that pattern for the future in terms of the potential for nuclear energy. And on the right-hand side, I show two graphs, one on the top. These are the projection of consumption or demand in the future according to a number of scenarios by the IEA. And if you look at OPEC or EIA future scenarios, 3-4 plausible scenarios, you see the consumption will be all over the place depending on which scenario you follow. And the same thing applied on the bottom curve. I don't want to have to expand it, it will be available, but the bottom curve is also indicates that these supply sources and resources are subject to a large degree of uncertainty. If I move now to describe the changes that we have witnessed in the energy system, as I said, it's driven by population, but one of the changes that we have seen is the population growth is now slowing down. So that's something to take note of, even in China, even in India probably is one of the last bastion of high population growth, Africa and Latin America, even there we're beginning to see population growth. And you could see that on the right-hand side, the growth in the future is going to come mainly from, essentially all of it is coming from developing countries, and even there it is leveling off toward 2040 or 2035. Prosperity or economic growth will continue to grow, but OECD countries' per capita consumption, economic activity will still be 5 times the rest of the world and 3 times of China by 2035 or 2040. So there is room for continued economic growth beyond 2040, and that means continued demand growth for energy beyond 2035, 2040, because China and the rest of the world is, at least in terms of consumption from present levels in developed countries, it's about 1/5 or 1/3, whatever number, depend on the particular countries. This happening despite the fact that energy intensity has been coming down. Energy intensity is coming down. That means the amount of energy you need to produce a particular unit of economic activity, it's coming down. It's coming down even in China. Still, you need extra energy to have extra economic activity, but the ratio is coming down. So that's another change that we have witnessed over the last decade or so. So that's an important part of the energy scene. And that has resulted, combined with the population growth being decreasing and the energy intensity decreasing, has resulted in energy demand growth is also decreasing to a level of about 1%, 1.2% per year. It used to be 2%, 2.5%. Still in electricity, in power, the average growth is around 2%. But if you look at the total picture, transportation, power, heating, what have you, the average growth, still we're talking about growth, it's about 1%. And CO2 intensity also in terms of growth is decreasing. So we see leveling off on the horizon. That's what the Climate Change Accord is trying to achieve. It's trying to continue to grow economically and even energy to grow, but to reduce the amount of CO2 that we emit. And that is not going to be easy. It's an important challenge, and that's why we have a lot of development in renewable and all low carbon technologies coming in. Now we've seen something very important happening as a result of all of the policies. In 2014, if you look at the graph on the right-hand corner, upper right-hand corner, you see that in 2014, for the first time, CO2 emissions came down a little bit. Unfortunately, this is just a temporary pause due to a variety of reasons. It's expected that CO2 emission will continue to grow for the next 2 or 3 decades, and by 2040 we probably have 30% more CO2 emissions on the globally. So I'm having, the response is a little bit slow, but that's fine. On the supply side, what changes we have seen? We have seen the dominant role of fossil fuel, led by oil, which used to contribute about 85% of the total and meeting the total energy demand, is now continued growth in supply from oil and gas is expected and coal, but the growth in alternatives such as renewable in particular is much higher rate, and therefore the share of fossil fuels is expected to come down from over 80% to something like 75% by 2040. And the dominant role of oil among all fossils is also expected to come down a little bit, so that you will have a democracy. Oil, coal, and gas each will contribute 25%, and renewable and nuclear will contribute the remaining 25% in 2040. In the power sector, we will continue to see coal and gas dominate. But as I said, renewable in OECD countries now are beginning to appear over the radar screen and beginning to show contributions at the level of 20% and perhaps 30%. So if we now move from power to liquid fuels, which is very important in this part of the world, based on oil in particular, we could see that liquid fuels will continue to be dominant in the transportation sector, despite all of the development of vehicles, electric vehicles, hybrid vehicles, efficiency improvement, at least in the foreseeable future. Although we have seen tremendous improvement in efficiency of the internal combustion engines in terms of miles per gallon and what have you, but we will continue to see liquid dominating the transport sector. And oil resources, contrary to what we were told over the last 2 decades, or previous 2 decades, 3 decades, that resources are limited and we are about to see a peak oil, we have seen this proven to be false, because the number of molecules in the earth, organic molecules, liquid organic molecules, gaseous organic molecules in the form of hydrocarbon, is almost infinite. The difficulty is that how to extract them. And as we develop technologies such as shale and becomes economic, suddenly you see the proven reserves doubled or tripled. Proven reserves today, when you count for shale in oil, is now approaching 2 trillion, 1.7, 1.8, 1.9, depending on whose estimate you look at. When Matt Simmons, the late Matt Simmons, was talking about peak oil in the 2000, early part of 2000, the proven reserves were about 1 trillion, and people were worrying that we will not have enough hydrocarbon and prices will go through the roof. That proved to be not the case, and we have seen the revolution of shale making the US at least not so much as an exporter of oil, but at least less dependent on imports of oil. Question is that, is it really a game changer for a long period of time or a short period of time? In my view, it is short to medium game changer, not a long-term game changer. More important, I think that the true game changer in energy will be if you manage to develop and commercialize a high density, high capacity, fast charging, low cost battery. Because if you do that and you combine it with renewable, you may actually prove that the world will run out, will move away from fossil fuels, not because we're running out of fossil resources, but because alternatives are really now commercially available. But I think this will be a long time to come. I have to be conscious of the time. So what are the challenges to the energy system that I've just described to you? I'm not going to go into the detail. I'm just summarize again, say the challenges are the economic growth, economic recovery, and how it relates to demand, whether it is in OECD countries, whether it's in China, whether it's in India, whether it's in Africa or the Middle East. Each region, economic growth prospect is different, has different challenges, and those translate into energy consumption, energy, supply challenges, each one of them. Climate change is the second one. And all of these, climate change and the economic challenges, result in volatility in energy markets. And we've seen that happen in 2014, all right, as a result of events that took a decade to develop. And suddenly we saw ourselves in a completely different setting, from scarcity of oil concerns about scarcity of oil, to concerns about a glut of oil that forced all of the producers to change course, including OPEC countries, which is mainly led by countries in this part of the world. And so the challenge for OPEC currently is that as a result of the scarcity and high prices, the fiscal price of oil, that is the price of oil to balance the budgets of the government, was approaching $100. That means you balance your budget at $100, not below. That's because you went into an expansion in economic activities. And now suddenly the price of oil is well below the fiscal price. And that is a major challenge for OPEC. And what is OPEC going to do about it? What are the countries of this part of the world going to do about it? I'll spend a few minutes to try to illustrate what is the outlook. The question arises, will current low oil price environment last for long? How long? And what is the resilience of the GCC countries, of the OPEC countries, and their economies to such an extended regime of low price of oil? And for that matter, what is the resilience of other producers, whether it is Russia or the United States, for price of oil? Now, when you look at the price of oil, you always see these pictures that you go 100 years and you see price of oil go up and down, and whether you count it in real terms or nominal terms, what have you. The question is that what's going to happen in the future? What is the future will look like? We were a year ago here, and now we are here. And so looking at the future has changed dramatically just over the span of 1 year. Over the span of 1 year, forecast up, high and low were way up. Even the low was way up, the forecast for 20, 30 years. And now the forecast for 20, 30 years, the outlooks are way low. Where are we heading? And what contributes to know where we are heading? This for the short term, just over the last year, see what happened. Did oil prices bottom out? The red line is the future prices. And you could see the future prices a year ago were here, and then here, and then here. And just a couple of weeks ago, we were here with future prices not above 35. And now we see future prices heading toward 45 or 50. That's if you buy a barrel of oil for delivery in 6 months. If you look at the think tanks that deals with this issue, whether it's the International Energy Agency, whether it's the Department of Energy, Energy Agency, EIA, or whether it is OPEC or McKinsey or whoever it is, they always are in the business of putting outlooks. And these outlooks are premised on assumptions about future oil prices. I summarize, don't worry about the details, what these price assumptions look like in 2010, 2014, 2015 for OPEC, for EIA, and IEA. And they were all over the place. And I just showed you that they were all over the place. Let's just focus on the latest one coming from the IEA in Paris. No different than the OPEC one that comes out from Vienna. They have 3 or 4 scenarios. And look at those 3, 4 scenarios in terms of crude oil import prices by scenario. You see the yellow, the bottom one, in the low price scenario, that price of oil is expected by 2040 to barely reach 80. Just a year ago, 2 years ago, when you looked at the same IEA, they were predicting in the moderate scenario that the price of oil will reach 120, 140. And so this is the uncertain picture that we have to deal with, and we have to try to find our way. And this is not new. We found ourselves in these crises. On the right-hand side, I summarize in a diagram what happened. But what are the reasons for the sudden forget about the long term. What are the reasons for the sudden drop in oil prices that we saw in 2014? Even before OPEC took the decision in November 2014. And the reason is simple. Whenever you have a crisis like this, it's usually a supply-demand imbalance. If you end up in a supply-demand imbalance where the supply is exceeding demand by much and expected to continue to exceed demand by much, prices will plummet. And unless somebody takes action to remove some supply out of the market, prices will continue to be plummeting. And OPEC actually throughout these crises took different decisions at different times, but not always cutting oil. In the 1980s crisis, actually OPEC, and led by Saudi Arabia, pumped more oil as prices were going down, as extra supply was available in the market. And they were after market share. There are reasons why sometimes you decide to take oil out of the market, and reasons why sometimes you actually pump oil into the market when the market is already oversupplied. And actually, this time is actually quite different from previous times. But the characteristics is that you have a situation in 2014, 2015, as those diagrams show, that the supply exceeded demand. And when OPEC took a decision in November 2014, the supply excess over demand wasn't that bad. The excess was around 1 million barrel, and stocks were rising. But after the decision, which means that OPEC was not going to cut, on the contrary, it took a decision to put more oil in the market. The excess supply over demand became 2 million barrels a day in 2015. And that explains why we saw prices not only drop from 120 to 70, which was thought to be the marginal cost of oil, that is the cost of the additional barrel, the most expensive additional barrel, which was thought to be shale at that time. We saw that as a result of the policy decision, the market became even more supplied and prices to continue to go further down over the time. And the question arises, why did OPEC take that decision? It's very simple, very simple. If you took a decision according to conventional wisdom that reduced the supply and let prices go up, okay, you knew that the shale oil producers and other non-OPEC producers, which usually produce expensive oil, they will take advantage and they will pump even more oil because you kept the prices high, and the marginal cost in those high-cost oil environment will become affordable in terms of the market. So you were faced with a situation, if you continued that policy, it was unsustainable. And actually, think about it. Should OPEC have cut oil production in the November 2014 and managed to keep prices, let's say not at 100, but let's say at 80, what would be the shale oil production today in the United States? Today, the shale oil production in the United States has dropped by about 500,000 barrels from its peak in June 2015. If prices had been kept at $80 as a result of OPEC taking out of the market about 3 or 4 million barrels, shale oil production today would have actually increased by 1 million barrels, not decreased by 500,000 barrels. So the differential would have been 1.5 million barrels, 1.5 million barrels, not half a million barrels. So you were faced with a situation that the market has reached a point that it's impossible to continue a policy of curtailing supply, cheap oil supply. And that explains why OPEC and Saudi Arabia in particular, and the Gulf country in particular, did that. Now, you may ask yourself, well, why did they take so long? And in fact, it was an error or a mistake on the part of OPEC to allow prices to go to 100 after the recession recovery of 2008, 2010. If you remember 2008, 2010, everybody was talking about a fair price of oil was $70 to $80, which was at the time the marginal cost of oil. And then suddenly, because of supply-demand issues, the producers in the United States kept putting more investment, seeing that there is a scarcity, So they kept investing and bringing in new technologies, reducing cost, but prices kept going up because OPEC was continuing to maintain its oil policy. The bottom line is that in a situation like this, if you continued the oil policy, you would not be able to have prices go up and you maintain your share. That basically the question. So going forward, what's going to happen? I think this is the big question. What is going to happen going forward? I think Saudi Arabia, Kuwait, the Gulf countries, the OPEC countries, even Russia, even the United States shale producers don't like to see prices continue to be below the marginal cost for most producers. At $30, almost everybody is losing except few OPEC countries. So there will be an agreement, but in order to reach that agreement, a number of things has happened. One of it within OPEC, there has to be an understanding that everybody has to share the burden. And between OPEC and non-OPEC producers, if there is no agreement to share the burden, the market forces will dictate sharing the burden. And this is what we are seeing happening in the United States. That's why we have seen the oil prices being low has forced the shale producers to curtail investment, to stop production in certain fields, and that had dropped production. In fact, in 2016, we don't expect non-OPEC oil supply to grow. For the first time in many, many, many years, non-OPEC oil producers will not be pumping additional oil into the market on net. Some countries will, some will reduce. On net, the only additional oil on the market, supply in the market, is going to come from the cheap oil, which is coming from this part of the world. And that's actually the policy. Now, there is big pain associated with that, and everybody has to share the pain. Now, the first step that was taken a month or two ago, the agreement between Saudi Arabia, Russia, and Qatar and Venezuela to limit production at January level is a good step forward. It's not sufficient. In order for it to succeed, other producers have to follow, either by joining the agreement or by actually being forced by the market to do that. So it's a question of just wait and see whether they will accept to join in, and that applies not only to our producers from outside OPEC, but also to producers from within OPEC, such as Iran and Iraq. Iran, Iraq, have plans to pump in 1, 2, 3 billion barrels more. Now, in such an environment, unless it's done carefully, it will be counterproductive. So they have to come around and be party to the agreement or let the market forces dictate that agreement. So, would prices stay below 30 or 40? No, they cannot, because the average cost of supply today globally is $45. That includes OPEC and non-OPEC. If you put OPEC aside, the average cost of producing barrel, the average cost, is $55. Some produce profitably at 30, and some cannot produce profitably except at 80. But the average is around 55. So if prices stay below 55 for much longer, some of those producers will go out of the market. And we have seen that taking place. That means prices will not stay at 30 for much longer. In fact, just over the last couple of weeks, prices went up to 40. They will not stay at 40. They'll probably drop back to 35 again. We have lots of volatility because the stock, the inventory is very high. And that will, on the short term, dictate the price for volatility. But on a longer term, it's actually the marginal cost for each producer that will dictate the situation. What is the impact? What's the resilience of the shale producers? You can see that in this graph, which shows what happens at $40. The US will lose about 3 million barrels from its potential 2020 target. And at $100, it will add a 1 million barrel above the current level. At $60, it will stay more or less the same. Now, some producers in the United States, they can make money at 40. So they're waiting for 40 or 50. But you could see that it's not a uniform situation. For the OPEC countries, the situation is different. most producers' fiscal break-even oil price is around $100. Now, with the price of oil dropping, that means all of them, essentially, with the exception of Kuwait probably, and Qatar, will go into a deficit. Should prices go below 40, even Kuwait will go into a deficit. But those countries have lots of reserves from the boom days that will help them to overcome this crisis. And in this graph, you could see on the left-hand side the effect of the shale prices. The most important is on the right-hand side. With the exception of the Gulf countries, essentially everybody cannot last more than a year or two. Except even Saudi Arabia at $30, they cannot last more than 3 or 4 years. Kuwait, even at $50, can last for more than 10 years. Let me now go to the second part of my talk, and I have 3 parts, and I will spend 5 minutes on this, and then 5 minutes on the last part. Given the fact that your conference is about energy R&D, what is the role of research in the development of energy technologies? To answer this question, let me just quickly say that without research and development, we all know, academics here, we know that without research and development, we will not have any technological development, whether it is energy, oil, gas, or pharmaceutical, or health. And we know that countries, advanced countries, this is a good curve that shows, you see the size of the bubble is the size of the expenditure, and then where it sits in terms of percent of GDP, expenditure on research versus the number of scientists. So unfortunately, in our part of the world, we are small circles here, and the rest of the world is circles there. What does this tell me? It tells me that we are not doing very well. Thank you very much. The problem is that I have to hold it. So, I think I'm not going to spend too much time arguing this, except to say that more or less the developed countries, as well as the emerging countries like China, have been spending around 2 to 3% from their GDP on research, and industries usually spend about 2/3 of that. Governments spend about 1/3 of that, and we are seeing China and other emerging countries now taking the lead. In our part of the world, in the Middle East or MENA, we are not doing very well, you could see. And actually, something to my surprise, I found that Iran is ranked one of the highest in the Middle East in terms of doing research. And I think this is, for us, is something to think about, for you to think about, that Iran, despite the fact that it has an economic problem, is the leading research country in the Middle East currently, whether it is expenditure per capita or per GDP, or whether in terms of publications and what have you. Now, if I look at energy research, this is what we are spending here in this part of the world, the Gulf countries. Until recently, all Gulf countries used to spend 0.3%. In the last couple of years, Saudi Arabia went up to about 0.5%. Kuwait, I think, is 0.4%. But look at Qatar, is at 2.8%. This is not energy. This is the total expenditure on research. Okay? So perhaps we have hope that we are now beginning to catch up. We're beginning to catch up in terms of what we need to do to meet the challenges. If I focus myself on the energy research, I think the energy research is dominated in OECD countries by public expenditure, and there used to be about $17 billion a couple of years ago, and globally it's about $22 billion. The US spent about almost 1/3. Okay, I don't see you. But All right. Okay. Well, we're having nice light show, so I will try to. The point I was saying is that energy research used to be dominated by public expenditure, but public expenditure on energy research dropped down dramatically. It used to be actually 11% of total public expenditure used to go on energy in the 70s. It dropped down to about 4%. And it used to be dominated by nuclear, and now it's dominated by renewable research. And Japan now continues to lead in energy research, all of the OECD countries. And the question is that with the low oil prices, many of the countries and many of the businesses are reducing expenditure in general and reducing expenditure on research in particular. And that's not a good sign. It's just from Bloomberg Renewable Energy, just to show how much investment has been going on into renewable. Now, in terms of research, renewable has been receiving about 30 billion globally. Half of it is almost from industry, half of it from government. But the rest is venture capital funds, equity investment, project investment, and that's really where the action is taking place. If I take focus on the Gulf countries, we in the Gulf countries started research in renewable in particular in the late 70s. Prior to the late 70s, the oil companies started research in oil and petrochemicals, whether it's Aramco, whether it is Kisser. But in the late 70s, after the increase in energy prices, Kisser, for example, took interest, CACS took interest, and there were a number of projects. One of the famous projects in Kuwait, we can still see it if you go to the desert. It's a complex that's shown here at the bottom. It's basically a 1,000 kilowatt thermal power plant, 100 kilowatt electric power plants that was built as a first prototype in this part of the world in the middle 80s. It doesn't work now, but it still stands in the desert. The landscape has changed now, especially in the 2000s. We've now seen new entrant coming from the UAE, led by Masdar. We've seen Capsar coming into the picture from Saudi Arabia and KAUST. And we've seen increasing interest not only in laboratory work, but also in think tank type of energy studies like Capsar and Masdar and others. So this is an encouraging sign about energy research in the Gulf countries. This is just to show you the Shagaya project, demonstration project that's led by Kisser, that will have two parts, the 70 megawatt and the 2,000 megawatt later on. Before that, I was showing you the KEFAS led projects, demonstration projects here in Kuwait for the supermarkets as well as private homes, demonstration, photovoltaic, rooftop photovoltaic. And you see examples like that in Saudi Arabia and Emirates and Qatar. So I think we are making progress. It's 11 o'clock and I'm coming now to the third part of my talk. So what I'm going to do is that I'm not going to go through the third part of my talk. You will see it in the handout that will be made available. I will stop here because I do have to leave in about 5 minutes, and maybe there's one or two questions that I can take up right now. So I want to thank you very much for listening and apologize for not being able to cover the third part of my talk. Thank you.